Hello there, welcome to another live webinar with me, Sri from Phillip Futures. And why are we here today? Is crude oil going to hit $100? Is this wishful thinking or is this actually a looming fact? With us in the studio is full-time trader and managing partner of Xmodeus Trading Group PLC, David Low. David, you have to let me know if I got your company name right. It's Xmodeus Trading Group Private Limited, and he will be guiding you on the key fundamental drivers for crude oil and whether the commodity could be headed to the $100 barrel price mark anytime soon. And David will also be discussing price direction scenarios and share strategies that you can use to trade the current market cycle for crude oil. Gain the insights that you need and tune in, all right? Tune in. The key points that David will be covering will be the key fundamental drivers that you should be watching out for crude oil, the technical reading of the current phase of market momentum, and of course, the potential price direction scenarios. If you are not already familiar with the kind of opportunities that you have access to with the CME Group suite of crude oil products, David will also spend some time to share the tools available in the CME suite, as well as the strategies that you can use to trade the current market cycle of the crude oil. All right, David, if you're all rigged up to go, I will hand the reins over to you in just a few seconds. First things first, can I just do a quick sound check with our wonderful audience? Can you hear me loud and clear? If you can, please head down to the question box, which is somewhere at the bottom of your control panel for GoToWebinar. You head down there and type a resounding yes. Let me see if you can hear me. All right, some familiar names, Mr. Prasad Kodukula, Robin, Jimmy. Thank you for confirming that you can hear me loud and clear. All right, David, if you're all rigged up and all set to go, I can hand it to you.
Thank you, Sri. Thank you for the great introduction and good evening to everyone. First and foremost, thank you, Phillip Futures, for hosting this event. And of course, thank you, CME Asia, for sponsoring this event so that we can get together this evening and talk about crude oil. So this is the question that I get a lot the last couple of weeks. Crude oil has been on a terrific run since last year, actually. So we will go into all those details and see whether it's headed there soon or eventually, right? So we have a very interesting session tonight. We will also take questions right after the presentation. So if you have any questions, you can put it into the chat box and we will take all your questions after the presentation. Okay, so just let me move my slides. Okay, let's see how this goes. All right, this is a picture of me. Sri was asking for my webcam just now, but if you guys know, I'm here in Kuala Lumpur and I haven't had a haircut for the last almost 2.5 months. Hair is actually coming out all from my ears, and I think I better present you with this photograph than showing you the live video of myself presenting to you.
David,
yes.
Are you going to bring back the band with your new hairdo?
Yeah, we will see about that, Sri. Yeah, so this is my picture. So I promise I will put myself on video the next time I get to have a haircut. I probably attempt one haircut by my wife this weekend. But anyway, that remains to be seen. But I do hope that everybody is keeping safe. Those of you joining us from Singapore and those of you joining us, of course, in Malaysia and all parts of, if it's non-Malaysian Singapore, I know this Delta variant is really moving really very fast across the region. So I hope that everybody is keeping safe and what do you call that, staying home. Right. So yeah, so I won't be introducing myself too much on this screen. Let's move on to the materials. Okay, this is what we covered, and Sri have already quickly gone through the outline. So let's look at the fundamental drivers. We will talk about each of the key drivers, and let's see which ones were the drivers that drove prices to the recent high at 77. And let's see whether these drivers still continue to move the market. Are there any other new fundamental drivers that will move the oil markets and the oil prices in the next weeks and months? Then we will go into the technical reading, and what I want to go into the phases of the market. I will be sort of explaining the phases of the market using Elliott wave. We'll see whether this is still continuing a bull market, or is it going to consolidation. We'll have a look at that, and of course talk about the various price directions. And we also have a very, very, very exciting new product launch by CME Group, and I'll talk about that new product launch shortly after we talk about the price outlook and the for crude oil prices. All right, so let's jump into it. Quickly, a quick disclaimer. This presentation is, of course, for general information, does not constitute any recommendation or offer to buy or sell any futures contracts. If you like to act on the products or the views that you gain from this, please talk to your licensed intermediaries to discuss those ideas. Right, so that's the gist of this disclaimer. Okay, now the reason why a lot of people are talking about oil this year is because it's so much focus on commodities, and especially in oil. And as you can see over here, this is basically a chart of the performance of across all types of assets and futures contracts since year to date until this morning at 11 o'clock. And you can see right on top of the list over here, which I circled in accent in red, you could see that the top 10 of those commodities or futures contracts are all energy contracts, right? You can see there's gasoline, natural gas, crude oil, heating oil, crude Brent. All these are the top performing futures contracts in terms of gains since the start of this year. And of course, a lot of people have been talking about the commodity super cycle, right? What about the oil super cycle and all that? So the last couple of months, a lot of people have been getting very excited about it. And that can be, of course, contrasted to the returns on the other asset classes as well. You can see that in terms of the indices like Dow Jones and the S&Ps, of course, they are in the mid-teens. They did very well, of course, since last year after the huge drop due to the pandemic, but they've recovered a lot. But so far this year, in terms of talking about the performance of assets, basically energy and commodities trumps every other thing, right? Whether it continue to do that for the rest of the year, or if it is a super cycle for the next 3 to 5 years, is something that we want to look out. But everybody's very excited about this asset class. Okay, that's why a lot of questions talking about energy, talking about gold, even talking about things like soybean and other types of commodities. Right, so let's go in and have a look at the WTI, right? So in terms of looking at the charts since last year, you could see the huge drop over here in April. Of course, this was unprecedented. Nobody could have imagined that the price of that particular contract, crude oil April, could go to below zero, which was minus 40.32 at intraday low on April last year. But there was a quick snap off from there, of course. And then the market, what it did was after recovering from those negative regions, it actually consolidated for a long time, right at this range here, for almost from April onwards until November. It was consolidating between 35 and 43. Okay, and then formed this very strong base right over here. Okay, and this strong base is where catapulted the whole drive onwards from 35 up to the peak of 77 on the 6th of July, right? So year to date, it's up nearly 59%, at the peak at 76.98. That would happen in 6th of July. And because of this, what do you call that, the huge run, almost more than doubling the price. Okay, a lot of people are asking, okay, can this continue to go on? Because the next what do you call that, price that everybody watching is 100. Okay, because the 100 price is something that a lot of people have forgotten, because they have never experienced that price for over the last 7 to 8 years, right? So people have almost totally forgotten about the $100 price levels. But interestingly, actually, in 2000, what do you call that, 11 and 2014, there were multi weeks of oil prices at 100. Okay, so at that time, 8 to 9 years ago, 10 years ago, oil being at 100 and above is quite a common sight, right? But just said the last 8 years, we have never seen that, and a lot of people have forgotten that oil could get there. So $100 oil is not something very unusual for those over the last 10 to 15 years, right? So let's look at what are the things and what are the drivers that can actually make oil go up to those levels again, if ever, right? So it's something that we want to try to answer. So let's move on. Okay, let's look at a few key drivers. Okay, and all these key drivers for oil has to do with the supply and demand impacts, right? And one of the most watched data that comes out every week is the US oil inventories, right? This happens every Wednesday evening. Our time is 10:30 in the evening, and this is a data and a chart from last week. Okay, I have an updated chart from yesterday, which you will see in the next slide, but this is from last week, and I want you to notice this particular area over here. Right, in terms of, this is the oil inventories, that means the oil stocks, and these are the changes. Okay, and this is published every week by the US Energy Information Administration, which is the EIA, right, commonly called the EIA Petroleum Report. And last week, actually, crude stockpiles, or the inventories in the US, dropped for the 8th consecutive week. Okay, what that means is the stocks have been dropping. That means people have been off taking oil. Okay, this is a signal of the continued response and the heavier demand as the US economy recovers, right? So stock have been going lower and lower and lower, right? And for yesterday, actually yesterday was a bit of a surprise. A lot of people were expecting there will be another drawdown on the stocks up to some 4.4 million barrels. But in terms of yesterday, the data actually came out quite surprising. Let's have a look at that. Okay, this is in a bar chart. You could see for the last 8 weeks, it has been 8 weekly drawdowns, peaking at last week at 7.987 minus in terms of the change. And yes, last week was actually up too. So there was actually inventories actually rose instead of going down, right? So that surprised a lot of people. So in terms of looking, I think it's consistent with the price. In terms of prices, after the July 6th high near 77, prices of oil actually declined for last 1 week. Okay, yesterday did a remarkable rebound. Actually, the data when it come in, when the inventories were to rise, normally it's bearish for oil prices, but surprisingly, it actually had a quick uptick, and then prices actually rose and recovered from the last 2 days low. Right, later we'll go in the charts and have a look at that. So but whether this one uptick, okay, we saw an uptick also over here in terms of mid-May, but that couldn't sustain. Okay, after that you had that the 8 consecutive drawdown. So whether this particular uptick where inventories are rising, will it continue to rise? We will have to watch every Wednesday. Okay, so remember, every Wednesday 10:30, watch for these figures to come out. This is one of the most followed data when it comes to supply and demand, because in terms of drawdowns or rises in inventories, it's basically measuring the net net sort of a net supply demand, okay, the net oil coming into the market and the not net oil going, the net between these two, right? So this is a very, very important figure to look at, right? So we don't know yet whether this first uptick is going to be a series of upticks. We will have to watch that. So stay glued to this data for the next couple of weeks. It will be very, very interesting. Okay, the next one is the US crude oil production. Okay, the US crude oil production figures actually come up monthly, but the data from the EIA seems to be a bit slow. I only have data until April. Okay, but in terms of looking at the trend of the chart, you can see that the United States crude oil production has been quite stagnant. Right, it's recovered a bit from April, of course, but you can see at the peak it was doing something like 12.5 million barrels a day, or up to nearly what do you call that, 13 million barrels a day. But now it's flattening out. It came to a low in April last year to about 1 million barrels a day. Then over here you can see it's about staying there about 1.1. Right, so about 11 million barrels. So it has been stagnant. It has not come out to the pre-pandemic levels. Okay, so it becomes it's very, very stagnant actually. The next chart, you can see the US rig counts. Okay, that means how many active rig counts are coming into the market. Basically, you can see the rise is also very, very slow. The recovery is very slow. In the week of July 16, it only added about 2 extra active oil rigs on compared to the previous week of 378. So in terms of looking at this active rigs coming and production, it's still very, very, very slow. And one of the reasons is because the financing for investments in oil, there's just basically no appetite to invest in opening up these rigs, right? Also because of the Biden looking at clean energy. So a lot of emphasis have been put more into the renewable energy area, right? So in terms of looking at crude oil types of investments, the investments have been rather slow, right? So you don't find a lot of these new rigs coming on board. Okay, even at this price, 60 to 7 US dollars a barrel, they are still not very, very incentivized to rush in and invest in oil production facilities. Okay, so that's one of the reasons as well why the oil production have been quite stagnant in the US. And interestingly, of course, in terms of looking at the oil rigs, is also talking about shale oil, right? So shale oil was the darling over the last what do you call that, the 2018s and 2019s, right? So shale oil also, all these producers have been holding back on spending despite the strong crude oil prices. Okay, one of those things is, of course, again, we're talking about investments into the shale oil, what do you call that, mining of this oil. It's a very expensive affair, right? And one of the dirty secrets of shale oil production is the first year you can get a lot of oil, and then on the second year onwards, your oil production from the same field actually drops tremendously, right? So sometimes your second year's oil out of that same area can only be about 30% of what you got in the first year. So they have to continue to find new what do you call that, fields to mine the oil and to get the oil. So it's a very expensive affair, right? So again, because of the lack of the investments, and of course in last year they got really hit badly, right? So in terms of looking at this, you will see that even the shale oil production has been very flat, or there's been very little money going into the shale oil, right? And shale oil was like the hero during the time when the US became a net exporter of crude oil products, right? Surprisingly, because nobody would have believed that could happen, because the US has always been a net importer of oil. And in those recent years, in 2019, after 75 years, they became a net exporter of oil, and shale oil was one of those contributors to these large production in oil, right? So in terms of looking at shale oil is currently not seen as a threat anymore in terms of bringing oil into the market. Right, as you can see, the oil production in the US has been very, very stagnant. Okay, so OPEC doesn't see the US shale production as a threat to them anymore, because all these new investments, all this new money going into energy investments are more being focused into renewable energy, right? So all these factors, you can see now that the OPEC factor has once again become a very important part in terms of the factors affecting oil prices, right? So OPEC, as you can see, which we will go to the next slide. Okay, so OPEC has been causing a lot of movements, and OPEC Plus, of course, with other associate, what do you call that, oil producing countries. In fact, beginning of July, when the talks of OPEC Plus failed because of the disagreement between Saudi Arabia and UAE, they were supposed to, UAE was pushing for more oil production, right? So when they didn't agree, they couldn't agree, that actually caused a spike up when they had no consensus. They spiked up on the next day, on Monday, on the July the 6th. That's where WTI hit a peak of close to 77, right? So volatility continued to persist over that particular week until last week on July 14th. Finally, there was some compromise between Saudi Arabia and UAE. And then, of course, just recently, last Sunday, you had OPEC Plus announcing that they will start returning about 400,000 barrels a day from starting from August, right? So that really sort of spooked the market a bit, okay? So they were thinking a lot of new oil will come into the market. So there was this sell down the last couple of days, okay, because of this particular news. But you need to keep watching what OPEC Plus does now, because their impact on the supply of oil into the global markets will be one of the key determinants of oil prices, including the WTI. Right, so these are the key drivers that you have to keep a watch out for. These are very, very important thing to look out. But so far we've been talking about supply, right? We of course talk about inventories, and then that is already showing ticks or what do you call that, tips on where the demand is coming from. But now let's talk about this. Let's talk about the demand side in the global economy. Okay, and this picture is July 11th. Okay, in 2020, during the pandemic, you never imagined to see this scene in last year, right? But this has already happened on 11th of July 2021 in the Euro 2000. This is a scene from the fans of the Euro 2020 final in Wembley Stadium. A lot of you may have watched their match. Okay, I couldn't stay up for the match because I was watching Wimbledon, and the fact that I saw that Wimbledon center court was so filled with people and nobody was wearing masks was an incredible sight. Okay, but what does this tell you? You know, this is a picture of if the world is going to open up. Okay, and it's not really open up yet, right? What is going to happen to oil demand? Right? What will happen if travel opens up again? And basically, you can see in terms of global travel, Asia is not even in the picture, right? Because we're still struggling. We're still fighting with this what do you call that? This COVID-19 virus, right? This pandemic, we're still battling it, and we're not like really opening up. And of course, these are scenes in Europe and of course in the US as well. It's opening up. People are getting back to normal in their life. Okay, and we have even seen the world the global economy coming back right up. Okay, so in terms of the demand picture, it's something that it's not felt yet, right? Because it's you still have a lot of planes parked in Australia, which is stranded there in Australia. They're not even flying yet, right? So this is what you can imagine if demands come in. Okay, but let's look at what the economists say. So this is the chief economist outlook for June. They published this in June 2021. Okay, World Economic Forum. And if you look at the views of the economists, right, you can see over here what the economists say about the global growth forecast for 2021. And you can see here, they are saying that the global growth rate for 2021 is 5.5 to 6 or even higher, right? So they are actually very optimistic of us coming back and the global economy coming back, okay? And in terms of looking, these are, of course, a survey. So you can see the bar height here is how many people are, how many of the economists surveyed in this particular range, 5.5. So a lot of them think 5.5 to 6 is very achievable, and the second largest majority is looking at 6 to 6.5%. This is very, very optimistic. And when is we going to go back to the pre-COVID levels? If you look at this particular bar chart on the right, you can see that a lot of them are thinking in the first half of 2022 we will go back to the pre-pandemic levels. Okay, and a lot of them also say that in the second quarter of 2021, which we are already in the second quarter of 2021, where the global economy is going to go back to pre-COVID levels. Okay, so imagine yourself if the global economy is able to pick itself up, okay, and go back to these levels, okay, what will happen to the demand for oil as the engine? And oil is, of course, the engine of what fuels a lot of economies, right? What if what if the cars are going back on the streets? Can you imagine? I've not refilled my car since March. Can you imagine that? I've not gone and pumped gas into my car since February. Of course, I've been locked down, right? So I mean, the situation in KL is a bit different. So I'm still locked down, right? And I've not even filled my gas. Now, what if I go on the road more often? Okay, what if I fill up my gas tank every month instead of every 3 months? So can you imagine that part, that demand picture that hasn't really been factored into the oil price? Okay, so this is something that we must think of, okay, and put into mind, okay. And in answering the question whether oil at this level now is trading at 70, when all these things kick in, can it really move to 100? Okay, so that question remains for you to think of, right? So this is something that we need to monitor as well. Right, but the key factor, okay, you need to note here over here, the key factor in terms of the recovery of the economy is the COVID-19 rollout. Okay, so as if the globally the COVID-19 vaccines are able to consistently roll out, and it looks like it is, okay, there is more urgency now, okay, for people to get vaccinated because of the Delta variant. Okay, it's just so virulent and so dangerous, this particular new variant. So I think a lot of fence sitters would be quite determined to get vaccinated, and also of the future mutations. Will there be some Delta or Omega or whatever that's going to come on and make things worse? Okay, so this is the key factor. So in terms of the caveats for all these economic forecasts, is this recovery from the COVID-19? Okay, so these two things, vaccination and mutation. So we need to watch these two factors in terms of the recovery of the economy. All right. So these are the key drivers driving the supply-demand picture for crude oil. Okay, so now let's move on and look at some technicals. Okay, and this is a daily chart. Okay, and I've drawn over here 5 waves. Okay, they have wave 1, wave 2, wave 3, wave 4. And in terms of these waves, these are for those who are not familiar with Elliott wave. This Elliott wave is the theory of how trends move. Okay, this is by Ralph Nelson Elliott, and he observed the various markets, many markets, and he's come up with this very well followed theory of the Elliott wave, where in terms of looking at a bull run or a bull trend, there is essentially a 5-wave up. Okay, as you can see over here, the wave 1, wave 2, wave 3, wave 4, and then wave 5. And then after the 5th wave is completed, there will be a correction wave of ABC. This is a three wave. Sometimes it goes to A, B, C, D, E, or five waves. Okay, so in terms of looking at the wave count currently, this is currently in a correction play. Right, so we have sort of peaked at the 77. This is can be said to be the current top. Okay, while this corrective wave play out. Okay, so we are now in consolidation phase. Right, yesterday the markets traded up to a 65 low and then bounced up. It's trading now about 70. Later we're going to look at some of the live charts. Okay, but what in terms of the Elliott wave theory, when it comes to the corrective wave, what happens is normally we will have a three wave action. Okay, so let's say for example, if yesterday's 65 low has sort of generated this A wave, that means the first wave down, then we can see the B wave currently. You will see the wave going up. It probably can even go up to even the high. If sometimes it does go up to the high, but most likely it's going to go up to about the 72, 73 levels, and then end up with the corrective wave near the wave 4 area, which is the 57 and 60 level. Right, this is where the wave 4 was previously, and the theory of Elliott wave says that the consolidation, the last wave, should reach up to this 57 to 60 levels. Okay, so this is the readings from the Elliott wave, and this is the expected current play for the market trend. Okay, currently in consolidation with it seeing landing near the $57 range. Okay, we may still continue to see higher prices the next 1 week or two, and then it is expected to move down to go lower below the 65 low and go down to the 57 level. Okay, so that is the Elliott wave target in terms of this corrective play. But let's look at the longer term chart. In terms of looking at the longer term chart, which is the weekly chart. Okay, now the weekly chart I've drawn from the low in April. Okay, then projected it now currently in this particular phase is the wave 3 phase. Okay, so wave 3 is the supposedly the most aggressive wave. Okay, it was supposed to go up to this 86 to 94 region for the weekly chart. Okay, so we have not reached here. Okay, we will see whether it can continue to climb towards this particular target zone. Okay, now for this wave 3 target zone, in terms of the Elliott wave theory, it may not exceed the $100 mark. Okay, it may go up to around the 91 mark, 87 to 91 mark, and then make one consolidation down, which is the fourth wave. Okay, and this fourth wave is supposed to take it near just now what we talked about 57, but it's likely to end around 55 to 61 area as well. Okay, so there may be a multi-week and multi-month consolidation, because the weekly chart is a very long-term chart. Okay, so when we look at a wave formation and a wave play out in terms of the weekly chart, we are talking about a period between 100 weeks to 150 weeks. Right? So we are talking about a trend between 2 to 3 years trend. Okay, so but one thing I want to talk about is in terms of looking at the wave structure. Now the wave, let's say for example, if wave 3 were to end at 91.4, right, and then correctly go down to a consolidation around the 55 to 61 level. Now after wave 3, okay, there will be a wave 5. Okay, in terms of the Elliott wave theory, there'll be a wave 5, and the wave 5 will exceed the high of wave 3, right? So we're looking at, in terms of the longer term, okay, the $100 crude oil in terms of the longer term, perhaps looking into next year, is very high possibility. Okay, now whether this is going to what do you call that, coincide to the economies, the World Economic Forum, where they talk to all the economies, whether it's going to coincide with the first half of 2022 is something we have to see, right? But in terms of the Elliott wave weekly chart, it does say that there is this possibility where there's a fifth wave, and this fifth wave will challenge the multi-year highs above 100. Okay, so in terms of looking at the shorter term, we may not see 100 so fast, but in terms of looking at next year or the first half of next year, coinciding with the view, if all things go well with the vaccination, and also we don't see new variants coming in to threaten the global economy, then there is this possibility, both foretold by the chart and as well as perhaps the forecast of the economists. Right, so $100 oil, the key question, whether it will come, it looks like there is a high possibility of that happening. Okay, so what do we do with all these things that we spoke about? We talk about price levels, and we talk about the possibility of this trend going to 100. How do we capitalize on all these opportunities? Okay, so that's what we're going to talk about in the next section. Okay, we are going to explore the trading opportunities with NYMEX and WTI crude oil futures and options contract, right? What's the use of knowing this without capitalizing on it, right? So that's where we want to cover. And we have this very, very fantastic new contract called the micro WTI crude oil futures or short called MCL, which was launched last Monday on the 12th of July. Right, this is a very what do you call that, awaited launch. Okay, I've been waiting for this contract for a long time as well, because WTI crude oil, the standard contract, is one of my favorite contracts in the CME suite of products. And of course, the micro WTI is a smaller contract, so it's much more comfortable for me as an individual trader to trade. Right, so we will look at this very, very exciting contract. And last week when CME did their what do you call that? The CME did a press release on the 13th July. They already said that the micro WTI has been the most successful commodities product launch in the company's history. Right, this is very exciting, and it's really, really moving very fast. Now, this is something you want to look at. So let's jump in to look at what is this new micro WTI crude oil futures. So this is actually a smaller size contract compared to the standard WTI crude oil. It's only 1/10 of the size of the benchmark contract, which is 1,000 barrels. So 1/10. So this contract is 100 barrels, right? So the MCL, or the micro WTI MCL, is a 100-barrel WTI contract. So when you buy one contract of the MCL, you're basically having exposure of 100 barrels of oil. Right? And all else, like the minimum ticks, are very similar to the standard size contract. So because it's a small size contract, then every single tick is $1. Okay, because the minimum tick for the WTI is 1 cent, so times 100 barrels is this is $1 for the MCL. So every $1 move, of course, if you see in the crude oil move, of course, if it's moving $1 because it's 100 barrels, then every dollar move is $100 in your account movement. Okay, but because the minimum tick is 1 cent, so it's $1 per the smallest tick. Okay, and this contract is cash settled compared to the large contract, which you'll see afterwards to compare. The standard contract is, of course, a physical delivery contract, right? That's where a lot of the commercials are inside to take and give delivery of crude oil, right? But for the MCL, it is a cash settled contract. Of course, more affordable, being a smaller contract. It gives me actually, as a trader, a lot more flexibility, because I like to do what we call position sizing, right? I don't what do you call that, just trade fixed sizes of maybe 2 lots or 3 lots. I tend to vary my sizes depending on the profitability or the equity balance I have to trade crude oil. So the MCL is perfect for that. You can size up, size down, a bit more flexible. Of course, if you are a big trader, of course you can size up and size down the standard contract, right? But for individual traders, and a lot of individual traders in Asia as well, they don't trade that huge a size, right? So the ability to be able to be flexible with position sizing is one of the most wonderful things that I can do as a trader with MCL. Okay, so of course, this particular contract expands the access to a lot more opportunities to traders of all sizes. Even the big traders, of course, can use this particular contract, right? But it allows them to be a bit more precise, right? Instead of doing a 1,000-barrel shot every time going in at the $1,000 levels, they can even size down to 500, 200 barrels, depending on how precise they want to size the position, right? So that's the beauty of the MCL. A lot of flexibility, a lot of precision is allowed with this. You can cut the size a bit smaller, right? Now look at the margins. Okay, this is the Phillip futures margins. Hope it's correct at the time of publish. This I think was inquiry last week. So this is the current one, $585 to trade a single contract of the MCL. So it's a relatively very affordable contract to trade, right? It's like just close to 600 what do you call that, US dollars to trade one contract, or in ringgit or in Sing dollar you can convert that. In ringgit, of course, it's only about 2,000 plus ringgit to trade one very exciting US WTI contract. The movement is fantastic. This is one of my most favorite commodity contract on the CME. Right, so you can see why this particular contract is so exciting and so attractive, right? So let's compare it with the three other available WTI crude oil contracts that currently listed on the CME. You can see, of course, we have the E-mini WTI, okay, which is actually a smaller contract of the WTI, half of it, 500, okay. I kind of liked it. I liked the E-mini, but the thing was the E-mini had this very weird tick size thing. It's a 2.5 cents per barrel, then per dollar tick 12.50. It wasn't that intuitive, right? But in terms of looking at the micro WTI, it was so intuitive, right? You know that every single tick value is $1. It's easier to calculate in the head, right? 500 is like, it's like a bit confusing sometimes. So to me, this 100 barrels is a perfect size, right? Although 500 barrels was a smaller size compared to the standard contract, to me, I would rather trade the standard contract. Okay, also for in terms of looking at the liquidity as well. Of course, the WTI standard contract is, of course, the most liquidity, right? So so this is my new favorite now, MCL. Okay, used to be my favorite is the WTI, right? So the differences are, of course, sizes and then per tick. Okay, the per tick is same for the MCL and WTI, and only the dollar value is 1/10 that of the standard contract. Right, both the E-minis and the micros are financial cash settled, whereas the commercial WTI crude oil futures is a physical settlement. Right, all else trading hours all remain, listing exchange NYMEX all remain the same. Right, so this is fantastic, except this keep in mind that the expiration schedule for the micro and the E-mini, it's 1 day prior to the expiration of the standard. Right, so you can see here the comparisons of the three contracts and why the micro, the MCL is so attractive. Right, so guys, if you want to look at the trading opportunities for WTI crude oil, this is a great place to start. The micros is a great place to start. Right, so let's move down to what we can do. This is an example for those of you who are new to trading a WTI crude oil. I gave an example here of a bullish scenario. If you think that the oil prices are going up, this example is for the MCL. Suppose that you feel that the crude oil prices are recovering and short term, okay, you say that, okay, A wave has completed down to the 65 low. I now want to trade the up wave, the B wave, right, for the short term, for the next couple of days or for the next week. So you buy the September, which is the active contract now, the September MCL. Say, for example, you buy at 70, which is the current price traded in the market. Okay, you buy one contract of MCL, this, for example, okay, which is a long futures position. You bought one at 70. Now, two scenarios can happen after you buy. Okay, so if scenario one comes up and perfect, you what do you call that? You called the trade correctly, and September MCL rises to 72. then you've made $2, right? You've got 70 here, now it's 72. You have a $2 gain, right? And because it's a 100-barrel contract, the $2 gain will make it a $200 gain in your equity or in your futures balance. Right now, not every time markets will go up or go the way that you want it to be. It can come down. So if September MCL drops to 68 instead of going up, you bought at 70 and now it's 68. Of course, there is a loss of $2, and you suffer a loss of $2 times 100 barrels, which is a $200 loss. Okay, so that's how you calculate the P&Ls for MCL. Right. So the thing is about this is very interesting. When I talk about a $2 move in the price of WTI crude oil, now there is a measurement called the average true range. Okay, and basically the average true range is just an indicator. Later we can go in and have a look at that in the live charts. It is an indicator in the technicals, and it's very popular to use that. Basically, in terms of looking at the ATR, or what we call average true range, it measures the average range, a daily range of one particular bar. So in terms of looking at the current situation in the WTI crude oil, the bars are trading between $1.50 to $2. That's the common range now nowadays for whole of last year. $1.50 to $2 range every day, right? So even you look at this, you say you bought at $70 and then it went up to $72. This could happen in less than a day or within a day, because the ATR for the W crude oil now is between $1 to $2, right? So that's a very common movement within a day, right? So there's a lot of opportunities in trading crude oil because of a very good movement and range in the market, right? So let's go into look at a bearish markets. Of course, now, okay, let's say for example, you traded it and you felt that now that crude oil has come up already, but you still of the view, okay, that it's still going to be consolidation, and it's still going to make that move, the ABC consolidation wave downwards. So you're bearish. So what you could do, of course, you can go and short the market. Okay, so for those who are new to futures, of course, one of the great flexibilities of trading the futures market is the ability to go short. Okay, that means you can sell. You can have a bearish view on the market and actually take advantage of a bearish view and short the market and make money when the market is going down. So in this example, also on MCL, we go short or sell one contract of MCL at $70. If scenario one comes in, the September MCL drops to 68, voila, fantastic. We have a $2 gain, okay? And a $2 gain, again, multiplied by 100 because it's a 100-barrel contract, you have a $200 gain. Okay, but if it goes up, okay, if it goes against you, of course, that is a possibility again. If September MCL is trading higher at 72, then you have a $2 against your position. You sold at 70, now it's above 70 by $2. Then the $2 multiplied by 100 is a $200 loss. Okay, so that's how you calculate your P&Ls if you are trading on the bearish market or on the short side. Right. So as you can see, the calculations are actually quite simple in terms of trading the WTI. It's a matter of how many dollars from your position that you have and which direction of the market that you are trading. Okay, so this is the examples for the futures markets in terms of the MCL. Okay, now there is another product in the CME suite after futures, which is the crude oil options. This again a very interesting contract. Okay, so you can trade options on crude oil as well, right? Let me quickly run through options, because options is a bit more complex product. So I will not spend too much time here. So you can consult your Phillip futures on if you would like to trade crude oil options. It's a very interesting product. But remember, in terms of the crude oil options, it's traded against the standard contract. So it's a larger contract. It's a $1,000 barrel options contract, right? as compared to the MCL. Of course, MCL is a smaller contract. But options has got its advantages. Okay, in terms of options, when you look at it compared to if you're buying options compared to a futures contract, there is less capital involvement because you're only paying the premium for that put or call that you buy. Okay, so in terms of options, of course, you have the puts and calls. Okay, but one thing good about options is there is the maximum risk. If you buy an option, the maximum risk of loss is limited the cost of your premium. Okay, and the upside, of course, if the options or the price of crude oil moves for you, there is unlimited profit potential. Okay, so you have a situation where you can have a limited loss and unlimited profit potential, and this particular proposition is attractive to a lot of people, right? It gives you a lot more flexibility. There's also other strategies where you can combine puts and calls and get a very different payoff, and that's why it is crude oil options, something that you want to look at as well. Okay, it is also a very active market. It trades averagely about 112 contracts, 112,000 contracts average daily volume in 20 and 21. In this year, 2021, it's quite active, right? Because the crude oil markets are very active as well. Right, so let's quickly just look at some of the examples. If you are bullish and you would buy a call option, okay, those people who are usually bullish will buy a call option because that gives you the upside when the price of oil goes up. So you could buy a September crude oil option. Okay, against this example is on $17, looking at the cost of perhaps a $3 option. Okay, so this $3, when you buy, say, a call option with a strike price of 70, okay, this is at the money. Okay, if it's a 70, it's at the money. If you pay that $3, this $3 is called the option premium. Okay, so that is the maximum loss you can lose if you hold the contract to expiry and it doesn't make money. That's the maximum you can lose. Okay, so in terms of looking at if you bought a call option, and if you are right, call option basically gives you the right to buy the futures contract at that particular price, which is 70. That's the strike price. So in terms of if the WTI were to go up to $80, then from your 70 to 80, in terms of in the money, you have $10, okay, times the 1,000 barrels, because this is a large standard contract. You have a $10,000 gain in terms of the price, but then you paid, okay, you paid 3,000 for the option. Okay, that's the premium, so you net a gain of 7,000. So you always need to knock off the cost of your option against the profit that you have gained in the market. Right, then in a scenario, if September futures were to drop to 60, you bought it at a strike price of 70. If it goes down to 60 on expiration, okay, of course you're not in the money, so this particular option will expire worthless. Then your maximum loss for this is the 3,000 you paid for the premium. Okay, so this are just a quick example of going long crude oil using a call option. Of course, you can go on a bearish. If you feel that markets are bearish, you could buy a put option. Okay, so in a very similar situation as well, let's say, for example, September crude oil, a strike price of 70, which gives you the right to sell crude oil at $70. Okay, you pay a premium of 330 for that particular right, which is the premium. Okay, that's the premium for the put option. So you pay 3,003, right? Remember, 330 times 1,000 because it's 1,000 barrel. So you pay a premium of 3,003 for this put option. Okay, so and if September WTI actually drops to 60, right, from 70 drops to 60, then you have a $10 multiplied by 1,000, you have a $10,000 profit. But always remember that in terms of option, the profit you need to net off with the cost of the option, which you paid was 3,003. So at the expiration, if crude oil price was at 60, then you have a net gain of 6,007. Now, if the trade doesn't go for you, actually the prices go up to 80. Of course, on expiration, this option, you will not exercise the option because it's worthless. So your maximum loss will be what you paid for the put option, which is 3,003. Right, so this is a quick and simple example of buying put options and previously call options. And this is one thing that you can explore once you are a bit more familiar with the markets, you can look at options as one of the viable instruments to trade the crude oil market as well. Okay, of course, calls and puts can be combined for a lot of different scenarios. You have things like straddles, where you basically are looking at the market not going anywhere. Okay, sometimes the market consolidate and it consolidates within a range. You can use this strategies called short straddles or short strangle, which gives you a profile of trading a sideways market, right? So for these particular types of strategies, you can consult your Phillip's dealer, and they will explain to you what types of strategies are available using the different types of puts and call options. Now, in terms of looking up and trading, I want to point you out to this fantastic tool over here, which is called the trading room analysis. This is a new product. This came out last couple of months ago. Okay, for those of you who have your scanner on, a lot of you these days work with this your scanner. You can scan this particular T-Rex and it takes you directly to that report. Okay, you can sign up for the report, and this is a fantastic report written by professional traders, giving you a view of the various markets on CME. Okay, what is the view? And these are what we call actionable trading ideas. You can actually use these ideas to form your trading strategies. All right, so this is a great way to look at the various products on CME. Okay, for those who don't have a scanner, you can also look at this particular. Go to CME Group and go to this link, newsletters, fresh from the trading room. Okay, this is a fantastic thing. So all those that you can scan the QR code over here, you will get straight directly into the link. Okay, so this is a great resource to have. The last issue in July 20th was talking about the hot and cold about inflation, and this is a very important subject, and it impacts all sorts of markets, from commodities to equities. Very interesting report, so I hope that you all can go in and have a look as well and see how that can help you in your trading. All right, so yes, so let's see whether we can have some time. We have a bit more time to, let's go into some live chart setups to see what's happening in the markets right now. Going to some short-term charts. So let me move. Those of you who have questions can start putting up in the chat group so that we can handle your questions. Okay, let's see. Okay, where are we? All right. So I hope you can see this chart. Okay, this is an hourly, sorry, this is a 4-hourly chart. Okay, so in terms of looking at the 4-hourly chart, in terms of the Elliott wave, you can see over here that there's this 3-wave down, which is typical. Okay, from this high of 76.998. Okay, it's have this 1 wave down. Okay, just let me draw so it's a bit clearer for you. Okay, it's got this 3-wave down. Okay, so this is very typical of a the A wave down. It's normally a 3-wave. Okay, so it's formed this 3-wave. Now currently for this phase, in terms of the 4-hour chart, for the next 1 or 2 days, it's gonna go up. Okay, it's gonna attempt a 5-wave up. Okay, so you will see next couple of days the high possibility of the prices turning upwards. Okay, it's probably looking at this particular section at 75, right? So okay, so this is the 4-hourly chart. Currently, it's also made a couple of buy signals over here. The other one just triggered about 4 hours ago, right? So we're still seeing some short-term upside. Let's move down to the 1-hour chart and see what's happening over here. Okay, in terms of looking at the at the hourly chart, you can see over here it's on the up wave. Okay, currently this is in terms of the short-term chart, wave 1. Currently it's still in wave 3. Okay, so there's still a bit more upside. Okay, so this could just let me quickly draw for you a possible 5-wave structure coming up over at the hourly chart. Okay, wave 2, wave 3 is still in play, right? So we'll probably have a wave 4 and then wave 5, then going in for the C wave down. Okay, so these are the possible scenarios. So it looks like in the short term for next couple of days, you can expect oil to recover and rebound from the lows of 65, with a possibility of looking at even at the 75 price levels, right? So let's go back to our questions. Sri, if you are there, do we have any questions on the chat box?
Yes, David, we have some questions that we will probably need experienced hand to address. Shall I read them to you?
Yes, please. Thank you.
Okay, the first one is from Prasad. He's asking if, I mean, it's a question I think that's on everyone's minds. The question is, will the EV decrease oil consumption, EV as in electric vehicles, decrease oil consumption in this decade? And would the price fall after?
Oh, that's a magic question. Okay, in terms of
course.
yeah, so I can only speculate with you. I join you to speculate. Okay, EV take up. It depends on the EV take up. Okay, this has always been something that a lot of people talk about a lot. Okay, and whether electric vehicles will overtake gas powered or petrol powered. I hope not, because I'm not a very big fan of EV. Although I like the smoothness of EVs, right, and how the cool factor of EVs. But I think this is a very long-term questions. A lot of people are still finding what do you call that answers to this particular question. So if renewable energies and all these are what do you call that are going to continue to pick up for the next 10 years, of course it will have a tremendous impact on crude oil, okay, and fossil fuels. But of course, in terms of looking at fossil fuel, is still the cheapest way to generate energy, even at this current moment. We will have to see whether there are new discoveries or not. I mean, people are talking about when all this come in and with autonomous driven vehicles, people don't even own cars anymore, right? So it could be a multi factor effect, right? People don't own cars. All vehicles now are electrical powered, right? So that will have, of course, a very, very deep impact long term for fossil fuels. Perhaps fossil fuels should stay below ground after that. But I'm as good as you in terms of speculating the answer, right? So let's continue to mull over that particular question, Prasad. It's a very long-term view of where the markets go. But us as a traders, in terms of trading WTI, I trade intraday. So my view is I make money intraday. And not to say not bothered, of course, of the future, that still has to come. But in terms of making money and all that, I look at 15, 30, and 1 hour charts. So my view is very, very short. Okay, so I hope that answers the question, Prasad. In a way.
All right, on to our next one. I think this question is something that a lot of beginners would ask when they are on the first steps to trading MCL. How do you know which contract month should you trade?
Okay. The contract, you should always trade the most active month. Of course, now the active month is September. So the quick and dirty way to look at it is you go to the CME website and just look at the volume the volumes of all the contracts that's listed in the W crude oil. There will be this most recent month which has the most volume, and that is the particular contract that you will trade. Okay, currently is September. Okay, also take a note of the expiries as well. Okay, your broker will of course always remind you of the expiries, but because the MCL is a cash settled product, is not as critical. If you are trading the WTI, which is a physical delivered product, then that is more critical. So in terms of looking at settlement, you don't have to be worried that you'll be delivered physical oil because the MCL is not a physical delivered contract. So that is one thing good for you as a smaller individual trader, because you're not a commercial taking oil or buying or selling oil. But the other thing is in terms of liquidity, right? Liquidity. So that's where your concerns is. Trade the most high volume contract, and a quick and dirty way is go up to the CME website and look at what do you call that? The contracts, the highest volume. Look at that particular contract. Okay. The easy way, of course, just to call your broker and say, hey, what do you call that? Sri, what's the active month for MCL? That's the quick and dirty way, of course. Okay, but the tip is, of course, to look at the most active month. And currently, it's September. Okay, back to you, Prasad.
Yes, feel free to reach out anytime you want to check which contract month is the most active month. We are happy to help you there. All right, so on to our next question. That is from Andrew. I see. Okay, David, I'm going to need your expertise to address this question. I would like to remain in the neutral perspective here. Any difference between the WTI and Brent contract, and why do you like WTI better?
Okay. The Brent contract moves hand in hand, okay, with the WTI. Okay. Now, if you are an individual trader, or of course, we trade whatever moves, right? Okay. We also trade whatever the price of because let's say, for example, if you trade a Brent, okay, the Brent will of course move in line with the WTI because these are correlated, very highly correlated contracts. Okay, but in terms of I being an individual trader, will I trade a Brent? I could, okay, because the movement is the same, okay, but I will go into trade something which is easily accessible, okay, perhaps the cost of even data could be a factor, right? Brent on ice is not a very cheap contract to trade, okay. There are ways to trade it, okay, but in terms of easier access, for me, okay, this is a personal view. Personally, I'll trade the MCL, okay, although in terms of trading the Brent as well, the prices are the same. So for the same thing, or the same trend, basically, if Brent is on the uptrend, the WTI is on the uptrend as well. Of course, there's a price difference between the WTI and the Brent. Unless you're trading a spread between these two markets, then it's a different matter. But if you're looking at trading oil as a commodity in terms of price movement, then you choose the contract where it is the most available, the easiest access, the cheapest way to access in terms of data and cost on platforms. Okay, which platforms support that particular product? That's very, very important as well. The availability of live charts and all that is also important. Okay, because in terms of looking at live charts, you're also looking at price data as well. So maybe a Brent crude oil live data setup will be more expensive for you, right? So if you do all these comparisons, okay, to me as a trader, I have a particular preference for the WTI because it basically allows me to go in and trade a lot quicker and a lot cheaper. That's my personal, what do you call that? My personal preference. Okay, so Andrew, I hope that
all right, David.
answers your question.
On to another question from Mitch. You mentioned at some point that there's some correlation with equity markets. Would you be able to advise which one will lead?
Whether the oil markets and equity markets, that's a very difficult question. Extremely difficult question. I don't really have a view on that, okay, on which leads which, okay, depending on which factors actually affect. Because what oil's impact on economy is if oil prices were to go up very, very high, okay, it will have an impact on inflation. Okay, so that's the key thing. That's why you want to check out that particular trading room analysis on inflation, because oil has an impact on inflation because it's one of the most used input into production and in terms of economic activity, right? So if oil prices go up and causes a very inflationary what do you call that impact in global economy, then that particular impact in terms of the inflation will cascade down, okay, into each of those companies that are the constituents of the equities, right? So in that sense, you watch out for oil's impact on inflation and the impact of that particular inflation on the equity markets. Okay, so whether it leads or does not lead is something that you will have to see at which level, okay, and at what sort of actions which the Federal Reserve will take in terms of a high commodity price, of high input prices to the economy. Okay, so that is the impact in terms of oil into the equity markets. Okay, so whether it leads or not, it's a question of which price level is oil at. So I hope that helps in answering that question. Mitch, back to you, Sri.
All right. Next one is from Mitch once more. He's asking what charts or indicators you use for intraday trading. What's your go-to?
Okay, so
are you going to share your secret weapon, David?
Oh, sure. No secret, but we'll share, of course. Okay, this is basically what I use to trade almost everything. Okay, of course now I use algos to trade, but when I'm not using algos to trade, then I will use this. You will see these few indicators here. Okay, this is a fractal. These arrowheads are called fractal. Okay, and these three lines are called the Williams alligator. Okay, and this chart over here is called the awesome oscillator. Okay, now for those of you who are interested to know how to use all these three indicators, I will point you to my Sifu, okay, my guru. But my guru is already passed away, but his legacy is passed down to his daughter. His daughter's name is called Justin Williams. My Sifu's name is called Bill Williams. So if you Google Bill Williams Trading Chaos, that is his book, which he wrote, and I've been following that method since 20 over years ago. Very, very good method. Okay, do look into that. Okay, Trading Chaos, CHAOS. Okay, by Bill Williams, and you will be able to see actually what I trade over here on my charts. Okay, very, very useful, a very, very elegant way. You can even sign up for the course. I'm not shareholders in the company, but you could shout out to Justin Williams. She runs now this group called Profittunity Trading, and you can reach out to learn the method from there. So Mitch, I hope that helps. Back to you, Sri.
All right, so we have this question from CK. CK is asking, when he bought the call, is he able to close the position before it expires?
Oh, okay, fantastic. Yes, the premium of the call, let's say, for example, this time we were buying a September 70 call at $3, right? So if the markets were to move, right? So the price of your call, if the market moves in your favor, okay, it will, because you are buying at the money, right? So let's say, for example, the market now move up to 75, right? So you are already $5 in the money. So you have the in the moneyness and you have the time value of your call. So your call will have a particular price. It now be trading maybe $6. Okay, from $3 trading $6. Okay, so you can actually sell your call at $6 or $5.50 or whatever price that it has gone up anytime, even before the expiry, right? Expiration, a lot of what do you call that, traders of options don't necessarily hold their positions right until the expiration, right? Just like not all people who trade futures will trade up all the way up to the expiration or the settlement of the contract. So whenever you see the price of your calls already made money and you feel that you have already met your target to make the profit, you can always take the profit, right? So you can sell your call anytime before expiration. Okay, back to you, Sri.
All right, David, this is a very key question. I think it's very important for oil traders. EIA data, inventories data, I mean the announcements for this, how much can it impact the WTI price?
A lot. Okay, there will be a consensus which is published before the EIA actual figures come out. So like yesterday, there was this consensus that what do you call that, that expected the drawdown on the inventories to be about 4.49 million or to that, something to that figure, right? But when the actual figure came out, it was actually a inventory build of 2 million barrels. So this was it's like, how much is the surprise factor? Okay, so if everybody expects it and it comes up almost expectations, then there will be no surprises to the market, right? But if it's those surprises in the market that actually sometimes jolts the market, right? So sometimes depending on what the position of the traders are. Now the thing about it is, even the EIA figures come out, sometimes the reaction can be totally different, right? Like yesterday when the figures came out, it was a inventory build, right? So inventory build, that means there are more stocks. That means that sort of equates to less offtake. That means less demand. The prices of crude oil should drop, right? But it didn't. It actually came up from 65 and shot up all the way to 70 something. So the thing is, it's a guide, okay? So you also, when looking at the inventory figures, you need to look at trends as well. Okay, you just can't take a one-off single week figure and treat that as the particular indicator that will signal where it's going to come. And you will notice that during the time when the reports are coming up, it tends to slow down, and then when the figure actually hits the market, and depending on what are the trader positions at that particular time, okay, if traders are very short and they needed to cover the positions, then you will see the huge price movement after the report comes out. Okay, so the EIA report, you need to look at the trend as well. You cannot just take off one week's one figure, like the figure we saw just now. There was an uptick, then followed by 8 downticks, right? So this one particular uptick in the build, whether it is going to continue or not, we also depend on the consensus view, and whether the consensus is actually confirmed by the actual numbers coming out. And as you can see, that the consensus yesterday at drawdown of 4.4, totally, the figures came out totally different from consensus. So even the experts who are what do you call that, trying to survey or trying to project that number also can be very wrong. So in terms of looking at trading, it's a good guide. Okay, in fact, during I don't trade during EIA because the volatility can go either way, right? So I'd rather not take so much risk. Okay, and it's good practice not to trade pre and pre data coming up, in order to be a bit more safe, right? So after the trend comes in, then you see the trend actually expresses itself, then use the chart to time your entry and trade the particular trend. Okay, so in terms of looking at fundamental drivers and all this what do you call that, data, it is better to look at it on a trend and a longer term basis to see the trend of the particular EIA or inventories, drawdowns, or upticks on bills and all that. So rather than trade a single data point per se. I hope that helps in answering that question. Back to you, Sri.
All right. Thank you so much, David. That's all the questions. Actually, we have one more. Would you like to address that?
Sure, let's take that.
Yeah. So our last question from Lam. He's asking, what is your holding period for position?
Good question. Most of the time, I'm in and out the same night when I trade. Okay, I usually, if I hold it overnight, okay. Now that depends on you as a trader. Okay. You see, every time you have a position, especially with trade Asia hours, and then the time is most active at night, unless you stay the whole night. And I normally don't like to sleep with a position in my head. Okay, so normally I'll be out of the position before I go to bed. And because I'm a day trader, okay, I trade say looking at the 30-minute charts or 15, but I tend to favor the 60-minute chart, so it's a bit smoother. Once I've hit my profit targets, I'll take that and I will. So I'm normally when I trade crude oil, I'm normally in the market around evening. Okay, but that was a habit because I used to be full-time working as well. So daytime I don't trade much. I'm in about 7 plus those times. Look for a position to get in, and then I'm out usually by midnight. Okay, so as a day trader, because of the range of the WTI, and of course WTI tends to be what do you call that? It has a characteristic to move quite a lot during the US hours because that's natural. But nowadays, even the WTI moves during the Asian hours. So that's something that you need to what do you call that? Take note of. There is also volatility during the Asian hours. Okay, although usually the Asian hour volatility is slightly less, but there are things that can impact the oil prices during the Asian hours as well. So for me personally, I have something like a 4 to 5 hour holding period. Okay, but it depends on you as a trader. Okay, some of you may like to trade it overnight. So some of those who look at hourly charts may trade and what do you call that, hold the position up till even tomorrow, right? So my gauge is normally if I look at a particular chart, say for example an hourly chart, the trend should play out within 20 bars. Okay, so 20 bars times an hour is about 20 hours. So normally within the day, sometimes I do take it overnight until the next morning's open, right? So that's my holding period, which I normally practice. I hope that answers the question. Back
All
to you.
right, thank you so much, David, for your insights and expertise.
Thank you so much. It's a pleasure.
And thank you for being a wonderful audience, and keep those questions coming in our future webinars. We will get back to you in our follow-up email with regards to how we can revise the insights that was covered, as well as details on our upcoming webinars as well. See you then. All right, thank you, David. Good night. Stay safe and get the haircut as well.
Good night, guys. All the best in your trading.
Take care, David. Bye-bye.